Okay, today's Cardinal lesson, we're talking about the income tax is the new estate tax. And I've been in the business longer than I really wanted to tell you, 48 years this month, and calling on people, sitting down with them, and just it's a given that everybody is going to pass away at some point. I mean, we're all going to die, we're all terminal. And what we do in our business is plan for that and plan how the money's going to go to the beneficiaries. And then we try to minimize taxes in that situation, which I'm guessing a lot of you want to do. And so, what I mean by the income tax is the new estate tax is the exemption is so large right now, and it's fixing to change and be lowered, but it's still very high. I mean, it's for people in the tens of millions of dollars, or where their estates are going to turn into tens of millions or 10 million. Let's just throw that in there as a cap. Yeah, and certainly if somebody's right at 10 million, there's some things they need to do to deal with the estate tax. But people that are at a million, 2 million, 3 million, 4 million, even less than a million, people that are at 500,000 where the value of their estate, the income tax to their beneficiaries is the new estate tax, and especially when that beneficiary is their spouse. And so we do this in a lot of our financial plans that we're helping people when it's kind of a known that they have a terminal illness or they have a chronic illness that's reaching the end stages. We're going to do some planning, or we certainly have the ability to do some planning. So I want to bring Tom on, and I want Tom to talk about why are we doing this video today.
Yeah, I mean, we're doing this video because there are a lot of tax planning strategies around someone dying. But it's really hard for us. I mean, we have a heart and we don't really need to be bringing up these right when someone has come to us after they've just got this diagnosis. And so we want to at least put this out there, let you start thinking about what are some strategies out there. And it's easier to talk about it more in advance than it is right when you're sort of in a crisis mode or you just got this diagnosis. And so let me bring up the show notes. They're pretty light today. It's mostly just the board, or it is just the board. But again, some people print it out, they'll have it, they can write notes on it. You can find this at the link below on our video. It's also on our website. We had a much longer show notes, but it gets really complicated. We had IRS tax codes in there, so we decided to sort of pare it down and mostly just spend today talking through the board and giving you some examples and some case studies to give you really help you understand what are some of these things you can do. And so I'll turn it back to Hans here, and we'll just jump right in.
Okay, so the first bullet point, and we've talked about this in several of our videos, so you want to find out how the income tax after your death affects your beneficiaries on your IRA money, you can go to some of our other videos. But I just put that as the first bullet point because it supports the title, is that pre-tax IRA money is taxable to the beneficiaries. And we have a lot of people that are already planning for this, and they're already doing Roth conversions, and they're spending the money, paying the taxes, and then they're saving money outside of that to so that when they pass things on to the next generation or to their spouse, that there isn't going to be an income tax, which is the new estate tax. So that's the first bullet. The second one, and what we're really talking about in this video today, is capital assets. So your home, if you own some rental real estate like some farmland or a rental house or anything that's a capital asset, a business. And then specifically, if you have a brokerage account that's not an IRA that has stocks and bonds, and again, capital assets, and you have inherent gains in there, is that you're not going to have to pay income tax on those capital gains till you actually sell the stock and realize those capital gains, and then you're going to find out about capital gains taxes. So what we're talking about today, well, first I want to give an example of this. Is what happens is there's a step up in basis that happens after your death, and this is a great tax advantage, and it serves to minimize income tax. So when you pass away, your capital assets are going to be stepped up in their basis. Or in other words, instead of using what you paid for them years ago, they're going to go to what they were worth on the day you died, and your beneficiary is going to be able to later sell those assets and not have an income tax. So let me give you an example, or much of an income tax. A stock purchased at $20 and it's now worth $200, and you pass away. I mean, if you had sold this stock before you passed away, um, you'd have $180 of capital gains. I'm assuming you would own thousands of shares or hundreds of shares. So I'm just trying to boil this down to a simple example. So you would have paid a capital gains tax on $180 if you'd have sold this right before you passed away. And the beneficiary, so now you pass away and your beneficiary sells this stock because they want the money. They don't want to hold it for a longer period of time. And they sell it for $210. So we're just showing a situation where it's gained $10 since you passed away. So they don't sell it right away. And the taxable gain that the beneficiary is going to incur is $10. So the moral of this story is, if you're not leaving this thing to your spouse, you're not holding it jointly, you're just holding stock. And if there's any way possible, hold it until after your death and then bequeath it to your kids. And then they're going to be able to sell it without a big tax. I mean, that's what a lot of wealthy people do. So it's taking advantage of the step up in basis. Now, capital assets like real estate, stocks, bonds held jointly receive a half step up in basis at the first death. So this is where there's a little catch going on in this. And I'm going to let Tom explain to you a capital asset, an example where some stocks were held jointly by a couple, and how the step up in basis is going to work. So go ahead with it, Tom.
Yeah, and so we have this on the board. I want to walk through this a little slowly just to make sure you understand how this works. But this in this example, we have a couple that has a taxable brokerage account, so not an IRA or Roth IRA. This show is really not talking about IRAs or Roth or 401ks, any of this. This is money outside of retirement accounts, but it is a joint taxable brokerage account. So both spouses' name is on this account. They own it jointly, and then one passes away. So we have a similar sort of the similar numbers on the board. The stock was purchased for $20. Let's just say, I don't know, 10 years ago. It is now worth $200, and the first spouse passes away. So we'll just use the husband in this example. The husband passes away. Now the wife inherits that. It really doesn't inherit it. It's her account now. The husband has been removed from the account because he's dead. And then she sells it, I don't know, a couple months later for 210. So the same kind of numbers we had in the first example, except now it's a spouse inheriting it, or keeping it because it's a joint account. The one spouse has passed away. Half of that stock got a step up in basis. And so we'll walk through the numbers. So we have this on the board. And so if the original basis was $20, half of that is 10. So the $10 of that $20 in basis gets stepped up to half of the value at death, $100. The $10 of their surviving spouse, that remains the same. And so now the basis of that stock is the 100 that got stepped up plus the original 10 of the surviving spouse. So it's $110 as the basis. Now that spouse sells it at $210. They look at the basis, which is now 110. The value, which is 210, the taxable gain is $100 on that stock. And that $100 would be subject to capital gains tax rates. And so that just is an example. Again, in real life, these numbers oftentimes are much larger than what we have on the board, but we just want to illustrate how this works. Where we see this happen a lot is with real estate, property, things that are held jointly, because that's something that's very often held together is your house. One spouse passes away. The other one is looking to sell it because maybe they want to downsize. They might want to move closer to family. For whatever reason, this is something that comes up quite often with real estate.
Well, sure it does. So we've just given you a couple of quick examples. And I mean, later on, we're going to talk through a couple of case studies where this is really affecting people. Now, let's talk about community property states for just a second. And so we've got them listed there right on the board. I'm not going to go through each one of them, but if you live in a community property state, you get a little gift from the government, and the federal government, the IRS, in settling and giving the step up in basis, honors the community property laws. They have to. So when you hold things jointly, you hold real estate or stocks or bonds, like California is an example, and we've helped lots of people in case studies out there where when two people are married, they hold the thing jointly, and then one of them passes away, they get 100% step up in basis on the date. So in community property, each spouse owns half of the whole thing. It's a little bit complicated. So, in other words, you get a bonus if you're in those states. You don't need to worry about this strategy. You got other things to worry about, but we'll talk about that. We just wanted to put that point up. Now, there's a strategy that you can implement. It's just the whole point of the video, and it's just really difficult for us as fiduciaries and advisors when people come into us or they just notify us. A lot of people, we handle their health insurance, so they notify us that they've just received a terminal diagnosis, or they've got cancer and it's not going well, or maybe we're working with them through the whole thing. And when they're couples, is Tom and I are always struggling of whether we sit down with them and explain this particular strategy where it's applicable, because it just feels like we're trying to tax profit or tax minimize off the benefit. It's not really a benefit dying, and it's a benefit to the beneficiaries. But anyhow, this is a point where we don't go running around talking about this stuff and treating it. It's just so what the strategy is. You got a married couple, and you could move substantially appreciated assets into the name solely of the person that's dying. So in other words, where it's 50, they're both names on there, joint tenants with rights of survivorship or joint tenants by the entirety, and they're not in one of these states, is the healthy spouse could gift the assets that are not in the IRA, the capital assets that are substantially appreciated, to the person that it's anticipated that they're going to pass away first. And spouses can gift to each other without any tax implications. That's pretty much in estate tax law. So it's not any more simple than that. And then when they pass away, the first spouse passes away, 100% of the basis gets stepped up to the value on the date they're done. And a lot of spouses need and want to sell things after the first spouse passes away, just because they either need the money or they want to move somewhere, or they want to gift it away. I mean, there's just all kinds of things that are going on. So this is a strategy, and there's a catch with it, is that the IRS is kind of wise to this under Internal Revenue Code 1014E, is there's a 1-year holding period, and they call it the boomerang rule. So in other words, if you did one of these, you can't do one of these transfers or one of these gifts to the spouse that is anticipated they're going to pass away. You can't do this on their deathbed, because that gift needs to remain in place for a year before the full step up in basis will be honored. So we don't want to get too much in depth to the strategy, and I wouldn't recommend anybody try to do this on their own. It's just, and then there's a couple of little things that the one spouse is losing control of the asset. I mean, it's just, so we don't want to take this lightly. There could be some reasons the other spouse that you've gifted it to could leave it to someone else. There's all kinds of things that go on. Anybody that you think you're going to put them on Medicaid, or you're going to try to put them on Medicaid, or they're going to be eligible, you don't want to be messing with assets and moving them around between spouses. So, and there's several other things. So we don't recommend this strategy for everybody, but it's something that people that have large assets, substantially appreciated assets, and they're pretty much for sure one of them is going to pass before the other. It's something that they ought to take a look at. Now I want to bring Tom back on, and I want him to go through a case study um, of one people that have benefited or possibly going to benefit from this strategy.
Yeah, and so we have a case study where we have a couple, and they have made some really good investment choices along the way, and they have a couple positions in their taxable brokerage account that are very highly appreciated. I mean, it's grown quite a lot, and so the nice thing of that is you have this asset that's worth a lot more than you paid for it, which is great. The downside is there are a lot of taxes, capital gains, sort of pent up in this, and you don't pay those until you sell the position, but it's sort of locked in there and they don't really want to pay the capital gains tax. And so one thing that they could do, and the other piece of this case study is the husband just got a diagnosis of lung cancer. They're treating it, they're fighting it. So it's hopefully we're praying that everything works out well, but just realistically, there's a chance that it might not. And so what we could consider doing is having the wife gift this appreciated asset that's held jointly solely to the husband to own outright. And then, if he were to pass away in the future and it's a year later, then that whole position would get a step up in basis to the date of the value upon his death. And now the wife has access to that money. If she needs it, she could sell it and have minimal capital gains on that. Whereas if they don't do this strategy and only half of it gets stepped up, there's still a lot of sort of pent up capital gains in that asset. And so that is just an example of a way that you can use this strategy. Like Hans was mentioning, this isn't for everybody. We don't take this lightly, right? There's a lot of implications of doing this, and it is hard to have those conversations, right? First and foremost, we're just, we're worried about how he's doing, how the family's doing, just health wise. But it is a tax strategy that we do feel obligated at least to teach you guys about, just so if you do find yourself in this situation, it's available. And again, upon the death of the second spouse, that gets a full step up in basis in really either scenario. So if the goal is to eventually pass this on to the kids, this strategy might not be that really beneficial unless we feel like the surviving spouse might need this money. We might want to take a look at something like this.
Well, and Tom and I are just struggling with this. Isn't the first client or the first case study where we're just always struggling. Should we tell the people this, or how are we going to tell them this, or are we going to ask them whether they want to hear this? Because as fiduciaries, we have an obligation to tell things to people that they could do that could make their taxes less. I mean, it's just that simple. So I want to talk about another case study where this lady is the beneficiary. The husband has already passed a couple of years ago, and she came into us and over Zoom, and we got to know each other, and she had just sold a piece of rental real estate because she hadn't been there in years, and they didn't even have it rented all that much, and it's down on Hilton Head Island, and she just sold it for like $550,000, and it's in a different state than her residence. So when she walks away from the closing, she hadn't really done any tax planning. She just knew she wanted to be done with it. And so she goes to the closing and they withhold $17,000 of state income tax for the sale of this rental property. And the lawyer withheld it and calculated this, asked her a couple of questions. And then she's coming to us saying, does that sound right? And, am I have to pay it again in North Carolina? And so I started digging into this thing, or we started digging into it. And we found out that she, first of all, her husband, we already knew, had passed away a couple of years ago. So they got this half step up in basis. So they had only paid like $199 for this place, or maybe $99. like 30 years ago, and then they had depreciated. Maybe it was 199, and they had depreciated that way down, and so um, their basis was pretty low if they had sold this thing before he passed away, but half the thing got stepped up, and so and it was worth 500 and some $1,000 when he passed away. So his basis, his half, got a big step up in basis. And so she's only really going to be taxed on the gain on her half. And then we further looked into South Carolina tax law. And even though they charge ordinary tax on capital gains, there's some kind of a 50% credit. So I don't want to get into the details here. She was just like, couldn't believe that she's going to get this step up in basis thing. Well, then we move on and we start talking about her personal residence. And her personal residence, and she doesn't have a lot of cash, this lady. They both have, she has a pension, and then she gets part of his pension as a survivor and his Social Security. And she's got some other money and from the sale of this real estate, but her home is worth about 1.3 million. And that's a big significant. She wants to sell that, but she really was concerned about the taxes because she just knew that there's going to be a huge tax bill. But when I started explaining the step up in basis, is same kind of thing where he gets a step up, or she gets a step up in basis based upon his death of half of it back when he died about a year and a half, 2 years ago. And then on her half, she gets to exclude $250,000 from the sale of her principal residence. So by the time we got done on doing all the math, she's going to be able to get by with about $100,000 in taxes of this $1.3 million home, federal and state. So she's real happy about that. And it's just, so what we've kind of wandered around here, we've talked about the step up in basis, which this was news to her. And I've found over the years, this is news to a lot of people. And then we're down here talking about, now that we know what a step up in basis is, now we're talking about in a marital situation where jointly held property, we're trying to figure out how we're going to get a half step up in basis. And, that's great. I mean, that's just going to come, but we're trying to figure out some strategies that we could turn that into 100% step up in basis. So I want to bring Tom back on, and I want to hear what Tom has for any comments on all of what we went over today.
Yeah, I mean, I think it's important to sort of understand the step up in basis. This is how a lot of assets pass. I mean, the really wealthy people, this is how they can pass assets on to the next generations and pay very little taxes. They just hold it until they die and then they pass it on. And so it's something to understand. One mistake that we see a lot of people make is they are getting older for whatever reason. They decide to gift their house, their primary residence, their property to their children. And don't get me wrong, there are reasons that can make sense, and so I'm not saying you should never do that, but I just want you to understand what the consequence from a tax perspective is when you do that. And so when you gift the property to your children in this example, you gift the value, but you also gift the basis. And so let's say you paid, I don't know, $50,000 for this house, and now it's worth $300,000, and you gift it to the children. That 50,000 basis goes with it. And now when they receive it, they receive an asset, a property for worth 300,000 and a basis of 50. You're still living there, and then maybe you pass away, and your kids say, "We don't want the house, let's sell it." Well, now they're facing a pretty large capital gain tax rate because you didn't hold it until you passed away. Alternatively, if you had just held on to the property, kept it until you died, and then passed it to them via a will or a trust or some way it went to the kids after death, then it gets a full step up in basis. They could sell it, have no tax implications. And so this is something, just an example that we see happen all the time. And a lot of times we're sort of coming into it because the parent has passed. We're dealing with the children. The children want to sell it, and they're trying to look to see what the tax implications are. And we have to explain, like, hey, they gifted it to you. Now you sell it, you're going to have to pay these capital gains. we can't go back in time, so we don't often harp on like maybe they should have done this. But if you're thinking about doing this yourself, I want you to really think through, what is the reason we're gifting it to them? Is it really necessary? Are we better off just holding it to get the full step up in basis when you eventually pass away in the future? So that's, again, I just want to point that out. Another thing I just want to make real clear, and Hans was talking about the community property states. Those states, for joint assets, you own them together, it gets a full step up in basis upon the death of the first spouse. So I have a case study. There was a guy out in California, which is one of these community property states. He had a pretty large real estate portfolio. So they had a bunch of real estate properties they were renting out. His own primary residence, real estate values in California have appreciated tremendously. And his wife had just passed the year before, and he was looking at trying to divest. He was sort of tired of renting them. He wanted to sell them, but what was preventing him was he was really worried about what taxes he'd have to pay. And so we explained to him that in a community property state, those properties got a full step up in basis at the death of the first spouse, even though they were jointly held. And so he could sell them and have very little, if any, capital gains issues. And so if you're in one of those states, it's more favorable from a capital gains tax rate because you get that full step up upon the death of the first spouse.
Okay. So, when we look at today's video and today's topic in the scope of the 7 worries, and when we're writing financial plans, we're going through all 70s. This is really an estate planning video. I mean, we're doing estate planning, and we're doing estate planning in anticipation of one of the first spouse to pass away. We talked a little bit today about 401k IRA, and there's moves that you can do with that, estate planning, and then, of course, income taxes. So I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.